Hey guys, Whitney here. Welcome to the Passive Investing Made Simple show. I'm your host, Whitney Elkins-Hutten, Director of Investor Education here at passiveinvesting.com. And I'm excited you've joined me today. We do the show live every Tuesday to help you learn how to turn your active income and savings into passive income and long-term wealth. So maybe you've tried to invest in a passive real estate deal before, but couldn't quite get comfortable making the investment, or you actually invested in a deal and you're like, oops, I made a mistake. Or you are a seasoned investor and you simply just want to sharpen your skills. If that's you, you're in the right place. Now, before we launch into today's topic over depreciation recapture, if this is the first time you and I are meeting, I just want to let you know that I have been in your shoes. I'm a partner in over 800 million in active real estate, mostly residential, but also some cash flowing businesses. I've also done over 5 million in residential real estate flips. And then I hold my position here as Director of Investor Education at passiveinvesting.com. I also coach investors one-on-one to help them build and scale their portfolios. And I'm the author of the book, Money for Tomorrow: How to Build and Protect Generational Wealth. Now, all these things are like cool vanity metrics, but let me tell you why I'm so passionate about helping you learn how to leverage passive investing, especially in real estate, like multifamily, express car washes, self-storage, even real estate debt, is because I want to share with you one of my biggest things in life, which is having time freedom, choice freedom. And this is me and my crazy crew here on one of our many adventures. And we look forward to having many more outdoor adventures. And anyways, I outline my entire journey in my book, Money for Tomorrow, which if you're looking at the video, you can grab the QR code there. But really, again, my goal in life, the impact I want to create in the world is to help you repeat some of the results that I've had, which is having not just financial freedom, because financial freedom is a tool, but more importantly, how you can have choice freedom, choice on how you spend your time. Okay. You may be like myself and my husband, who we do enjoy our work and enjoy our careers. But maybe you are the person that just wants to travel, full time. Maybe you want to start a nonprofit or something like that. Well, we can actually help you achieve some of those freedoms in life with our investments here at passiveinvesting.com, be it whether you're deploying in the equity side of our business through multifamily, self-storage, and express car washes, or if you want to invest in the debt layers of the capital stack through our real estate debt fund and our PIK yield fund, we can help you do that and achieve similar results. Now, before we launch into today's topic, okay, this is your invitation to join the Passive Investing Club. You can go to passiveinvestingwithwhitney.com. There, you're going to get priority access to all of our open deals, a one-on-one call with me. That way we can discuss your investing goals. And then, of course, you'll be plugged into all of our weekly educational masterclasses and resources. Now, today we're going to talk about depreciation recapture. So that is going to fall very solidly into the tax realm. We are going to talk some math, but I want you to understand that this series is for education only. It's to help you define terms, figure out how all these different areas of passive investment fit into your overarching passive investing plan. So it's education. So please don't consider it financial advice, legal advice, tax advice. Always consult with your team before making any investment decision. All right. Well, let's kick it off. All right. Depreciation recapture. Now, you may be listening to this and going like, okay, maybe I understand on a basic level what depreciation is. Okay. That's where the IRS lets me, as an investor, reduce my taxable income based on the asset's wear and tear. So when I invest in, say, a single family rental, multifamily rental, either by myself or with partners, or it can even be with like a self-storage building. Okay. The IRS is going to give me the write-off of depreciation. Essentially, they're going to allow me, based on certain accounting measures, and we'll talk about those in a second, take the part value of that building and write it off over time. Okay, because they want me as the investor to continue to solve problems in the market. Okay, so they know that building is going to wear out, and even some parts of that building are going to wear out faster than others. And so they're going to partner with me in order to help me as the investor keep that building in repair. Okay. Now, there's a couple of different accounting methodologies on how we can account for depreciation. Okay, so we can either take what we call the inline depreciation. So say like we buy $1 million property, building and land together are $1 million, and let's say the property itself is $800,000. Okay, the improvements, the building, everything like that, okay, that's been put on the land is $800,000. I can either take that $800,000 and divide it by, in this case, if it's a residential property, 27 and a half years, and I get to write that off, that lump sum off every single year. Or I can engage in a different type of accounting method called accelerated depreciation, where I accelerate different parts of the depreciation up into the first 5 years of the asset. Okay. Now, the reason why I might engage in accelerated depreciation, and this requires that I actually hire a special type of engineer. They're going to go through the building, they're going to break it up in all its different components. Anything that breaks down in, say, 15 to 20 years or less, they're going to push forward to the first 5 years of the project. Okay. Okay, that allows me to make improvements on the property earlier than waiting to let that depreciation build up over time and then make improvements later. All right. So the first type of depreciation I described, inline depreciation, and then the second type of depreciation I described, accelerated depreciation, are accounting measures. Okay, that's baked into the IRS tax code. Now, a lot of what's been getting, newsworthy, in the past few months is the rebirth of bonus depreciation. Right now, it's 40% this year. Okay, so whatever I have in accelerated depreciation, I can take 40% of that and accelerate it to the first year of the project, not wait to take it over 5 years, but in the first year of the project. Okay, that's a tax incentive. Okay, so I just want to make sure everybody understands the difference between the accounting methodology, which hasn't changed in several years, several decades, really. And then what we're talking about is that are tax incentives, like, bonus depreciation. Now, how do all this play into our discussion today of depreciation recapture? Well, because what the IRS giveth, they also can take away, right? Mind you, they want us to solve a problem long term as an investor. So when the property sells, okay, be it a multifamily building, self-storage, or whatever, the IRS may require us as the investor to repay some of the tax savings that we got through depreciation, especially if we fast forwarded it to the early years of the project. And this recapture can actually happen even if we, regardless of whether we got a profit or a loss on the property. Now, before you, as a limited partner investor, go, oh my gosh, scary, okay? I'm going to show you how this may or may not impact you, and more importantly, what you can do about it, okay? But let's talk about this. Let's kind of draw out a little chart. So maybe we have a property, we invested in a multifamily building, and it sells at a gain. We almost can guarantee that there's going to be some sort of capital gains tax that happens on the gain of the property, okay? Because we sold it for a gain, more than likely and if we sold it early and we didn't run out all of the depreciation clock, we're probably going to have depreciation recapture. So in theory, okay, without taking into account any part of our tax situation, and if we have losses that we can still use, there will be a dual tax hit, okay? Now, that tax hit could essentially be zero, and I will show you how the math works out here in a little bit. But when property sells and we sell it at a gain, we make money. We should have a little bit set aside to account for the potential taxes that we pay on the property. Now, here's the thing. we get to, as an investor, we get to work with our accountants to arrange our affairs as such that we pay as little tax as possible on that. So that's the cool thing. Okay, but as we're checking the boxes, yeah, gain, totally we're gonna have a tax on the gain. Depreciation recapture, if it's there, totally we'll have a taxation on that. Now, if the property breaks even, let's say you bought it for $10 million in year one, you sell it for $10 million in year three, do you have a capital gains? No. Okay, so you're not going to have any capital gains tax, but you still could have some sort of depreciation recapture that's triggered. And this is where investors can get surprised. They're like, whoa, I have to pay a tax on that? Well, yeah, you wrote off some of the depreciation over those years of the hold. Okay, the IRS says, hey, you didn't hold it for 27 and a half years in the case of a multifamily building, or 39 years in the case of a self-storage building. So you give back some of the losses that we gave to you. Okay, you got to pay some tax on that. You got an advantage. All right, so that can cause a little bit of surprise. But again, we get to work with our accountant to arrange our affairs as such that we pay as little tax as possible. Now, here's the stinger, okay? What if you sell a property at a loss, okay? Are you going to have capital gains tax? More than likely not, okay? But we're going to put a question mark here because we got to let our accountants do all the math, all right? Are we going to have depreciation recapture? Probably have some sort of like a little bit of depreciation recapture, okay? Even if the property is sold at a loss, because what? We got to benefit from those tax losses, okay? We may not get paid in equity, but we did get paid in tax depreciation, okay? We got that benefit of a loss, okay? Now, here's the thing, the net tax impact, okay? Our accountants are going to have to take a look at what if we sold it at a loss, what happens there to the basis? They're going to have to take a look at the depreciation recapture. And so really our accountants are going to be the ones, our CPAs that help file our taxes, do our tax strategy, are going to be the ones to help us navigate what kind of net tax impact there is at the end. Okay, so it really depends on the size of the loss if we're going to own anything. All right. But here's the clear thing. This is why I want you to understand that this isn't as simple as you trying to track everything, on your personal, like on a spreadsheet at home or anything like that. And why, when you ask an operator, hey, am I going to pay taxes, that they can't answer? Because they're going to hand you the K1. They're going to know that the asset side of, what losses are being thrown off, what the gain is, how it's being categorized. But really, it's what you do with it, with your accountant. That's what's going to trigger any sort of capital gains tax or recapture tax. Now, let's take a look. Where does this all kind of like fit in? Okay. So there are a couple different ways to depreciate. Okay. So when we look at depreciation, especially if the operator is doing what we call an accelerated depreciation schedule, where remember they hired that engineer and that engineer went and broke up all the different parts of the property. Okay. Anything that's getting depreciated, say like in 15 years or less, is going to be taken on, 1245 depreciation. Okay. And we're talking about residential property here, not necessarily like a self-storage building. Okay. Now, if it's structural, okay, like the foundation, the actual, like the structural part of the building, that's going to be taken on a 27.5 year schedule and claimed on Form 1250. Okay. Or under that depreciation code. So we've got two different tax schedules. Even with an accelerated depreciation, we got two different tax schedules running. Okay, this is where it's super vital that you get your accountant involved early and that they're looking at the K1s. Now, because we got these two different schedules that are running, okay, and some of this is getting used up faster at a faster pace than others, this is where we get into, we have to understand what our adjusted basis is in the property when it goes to sell. Now, if your head's spinning right now, and you're going, well, Whitney, come on, I don't really understand depreciation recapture. That's fine, okay? Be aware of it, But this is where we have to partner with our accountant and let the experts help us. But I want you to understand just some of the terms here. So adjusted basis means our purchase price plus the capital, whatever we put in for capital expenditures, minus the depreciation. That becomes our adjusted basis. So if the sales price is less than the basis, we probably are going to avoid recapture. Okay, remember we're on this previous screen and we got this whole it depends. Okay, this is how we get to the it depends. But if the sales price is still greater than our basis, then we're probably going to have some recapture and capital gains. They both may still apply. Okay, now before, again, remember, don't get scared here because most passive real estate investors are not able to actually use all of the depreciation that is given to them on their K1 or allocated to them on the K1, meaning they can use enough depreciation to offset the income gains that they've been getting, say like through cash flow, but they haven't really, because they more than likely are a business owner or a W-2 employee, meaning they do more hours in another job or business than they do in real estate. All those losses stay suspended on the tax form on their 1040, meaning they can't use them. So that's the beauty. Those unused losses, whether it's from that specific investment that's selling or other investments that have given you like suspended losses, now that can offset the future recapture and gain the property. Okay, so that's the silver lining. Okay, so the key takeaway here is just because you've used up your depreciation, okay, or part of it to offset like your gain and recapture doesn't actually mean that you get off tax-free, okay? Just because you fully depreciated a property doesn't mean that you're actually immune from recapture, okay? Recapture is based on the total depreciation taken or allowed. You have to know your adjusted basis to calculate what's really owed. All right. So this is where you got to partner with your accountant. Now, before we help you understand what paperwork you need to keep track of, what conversation you need to be having with your accountant through the life of a hold of an asset, I want you to understand as a passive investor why this really fully matters. Why do you have to, again, like be aware of what depreciation recapture is because we don't want you getting surprised. Nobody does. I don't want to be surprised as a passive investor. And operators don't know your personal tax situation. So this is the beauty. You get to take advantage of private equity real estate, okay? Passive investing syndications in order to craft the portfolio that you dream and desire. But it also means you have to take on tracking all the different documentation and tracking your depreciation or at the very least, having your accountant do this for you. That way you don't get surprised by a tax bill. Okay. We don't want you, nobody does. We as the operator and also the we as a passive investor, we don't want you having a property sell, you get the gain of a property and you're like celebrating, you're like, yes, I made money. And you reinvest everything. And then the next April, when you do your taxes, your accountant goes, hey, guess what? Here's your surprise tax bill. We don't want that happening. Okay, so how can we avoid this? Okay, number one, if it's not clear already, you have to know your numbers. Okay, now if you aren't going to track this, this is where we're going to engage our CPA, which I really encourage people to lean on their CPAs to do this. Your CPA should be tracking all of your K1s. Okay, so anytime you invest in a deal, whether it is an active real estate deal where you've taken depreciation, or you're in a passive real estate deal that is throwing off depreciation, your CPA should be setting up what we call a depreciation table. Now I'm going to show you what one looks like, a basic one, okay, not the kind that the CPAs use, but one that you can set up yourself and track. But you have to know your numbers, okay? Your CPA, every year you get a K1, they should be setting up your depreciation tables and updating those. Okay, because all those tables get actually included in your tax package. All right, every year, not at the end of the year when you can't do anything about it, but at the beginning of the year, you should be talking to your CPA about any passive losses you have sitting on your tax return. So ideally for 2025, I would want to have had a conversation at the very least in January of 2025 saying, okay, I think these 2 or 3 investments might sell this year. Okay. Or I plan on selling these 2 or 3 investments. Say, like, you own the building. What kind of losses do I have on my currently on my 1040 that I can use to help offset any gains or recapture? Okay. So your CPA should be able to guide you through that conversation. All right. Also, as soon as you know an asset's going to sell, you should be partnering with your CPA to understand your adjusted basis in the asset, and your CPA should be helping you understand your projected exit amount. Okay, so this is where you're going to have to get some information from an operator, but then your CPA is going to plug in on the numbers and go, okay, this is what we're anticipating for a gain. This is what you might be owing in capital gains and recapture. Okay, now as promised, I wanted to give you a basic way for you to track your own depreciation and be able to figure out what's actually gain on a property. Now, when we had our webinar over tracking K1s at the beginning of March with our very own, uh, you know, CFO, Tal Brody, our director of finance. This is the simple tool that she gave everybody. Okay, so this particular example is tracking a multifamily deal across 4 years. So in this case, this is just an example. I'll walk you through it. In this case, the investor invested $100,000 in 2021, okay, in year 1 in the asset. Okay, and let's pretend it happened in January. Okay, that year in 2021, that asset threw off $50,000 in net income loss through depreciation. Okay, net income loss through depreciation, but it actually distributed $8,000. Okay, so that left us with an ending capital balance, $100,000 minus 50 minus 8 of $42,000. All right, so then the next year it threw off $15,000, right? So that, clues me in that we did an accelerated, this investor invested in a deal that had accelerated depreciation. So a lot of it got shoved into year 1 in the asset, but we still got sizable chunks of depreciation in, 2, 3, and 4. Okay, so year 2, we get $15,000 of depreciation, we get our $8,000 in distributions. But because our capital count now is $42,000, we're going to take the 42 minus the 15 minus the 8. Now our capital count is down to $19,000. We're going to repeat that for 2023 and subtract $5,000 of depreciation minus $8,000 of withdrawals. Now our capital balance is down to $6,000. Okay. Then in year 4 of the hold, we have just a little bit of depreciation left over, $1,000 that was taken that year. But we sold the asset, and between 1231 and 1250 gain, because remember, you got 2 different depreciation schedules running at the same time. Okay, the 1231 or 1245, I think it is, don't quote me on that, is going to be like, depending on what type of fixtures, landscaping, the things that wear out really fast in 15 years or less. The 1250 gain is going to be the structural part of the building. The combined gain there upon sale for this investor, their allocation was $95,000. They got $100,000 that was distributed to them, their original capital back. Okay. So, but because their capital account balance was $6,000, they got $94,000 of total income loss, and then their distribution. So now their total gain is actually only $24,000. So this is why I want you to encourage you for your investments, track this, because you're gonna just because they got $94,000 back in their bank account doesn't mean all of that was actual gain. The overall gain was $24,000 for the investment. All right. So this is where your accountant should be helping you track everything over the actual lifetime of investment. All right. So how do we prepare? Okay, that's what we should be doing through the lifetime hold of our investment, whether you do it or you have your accountant do it. But now we actually have been notified of the sale of an asset. What do we do now? Well, the first thing we should do is as soon as we're notified, we should be reaching out to our CPA and having them extract out of us all the documents they need to do their estimates. And what they're going to need to know is like, what was the initial investment amount? What were the estimated capital improvements? You're going to have all that in your financial documents. Okay. If it's a current CPA, they should have all the K1s for that asset. If not, you're going to have to give all the K1s with the depreciation. All right. The CPA is going to need to know if you have any suspended passive losses. If it's a new CPA, you're going to have to give them old tax returns. If it's a current CPA, they should have that. Then they're going to need to know what is the estimated sales proceeds and the closing date of that so they can start doing their estimates. All right, now the last piece of the puzzle is they need to know from you, what is your reinvestment strategy, if any? Okay, because remember, we can either reduce the amount of tax we pay on depreciation and recapture by using other losses that we already have existing on our tax return. We can also participate in a 1031 exchange or an opportunity zone, or maybe you're going to do what we kind of call, tongue in cheek, the lazy 1031 exchange and invest in another deal in the same calendar year that's going to throw off losses. Okay, your CPA is going to want to know that strategy. But here's the cool thing. You get to arrange your affairs as such in order to significantly reduce, if not eliminate, that recapture and gain altogether. So, all right. So the last piece of this is just making sure that you're staying on top of everything with the operator as the asset goes to sale. Okay, so if there's any issues with exiting that property, you're going to want to know this up front. Does the buyer actually have to sell their own property before you can exit? Okay. If you can the operator give you any sort of, depreciation and recapture estimates up front? This is usually fairly difficult to do, because closing statements are still being finalized, sometimes up into the day of close, but any type of information you can gather in advance is useful. All right. And for you as a limited partner investor, you're going to want to make sure that you're keeping some reserves just set aside to cover taxes. All right. We don't want to have those surprise tax bills. I usually, utilize some of my tier one liquidity savings or my tier two cash flow to help mitigate any type of those surprises. All right. So this is a quick little summation of all the different ways that you can mitigate depreciation recapture and capital gains. You could go through a 1031 exchange, okay, where you defer both the capital gains and the recapture. 1031 exchanges, they're pretty rare for limited partners, in passive real estate, but when they're available, they can be a great tool. You just want to make sure that is a property that you actually want to exchange into. Don't do an exchange just to avoid the taxes. You want to make sure you're doing exchange because it is a solid deal. Opportunity zones, again, you can defer the gain and reduces future taxation. These opportunity zone funds are generally reserved for investors with really large gains. Sale of their own multi-million-dollar properties, potentially even sale of large businesses. Okay, so for the average limited partner investor, maybe not as accessible. Okay, depreciation, rich deals is, as we kind of mentioned, the lazy 1031 exchange. This is a simple and easy way for a limited partner to avoid depreciation recapture or the taxation. What they actually do is they actually pay the taxes, capital gain taxes and depreciation on one deal, but then they use the losses that they have on a future investment in order to wipe that out. Okay. And this is really great for limited partners that are going to always invest in limited partner deals, those serial investors. Okay. And then we've got our investor. If you're qualifying as a real estate professional, you can actually use some of the passive losses to offset your W-2. Now, if you've done this, if you're consuming all those losses, to offset W-2, say like a spouse's W-2 or any other W-2 income that you might have. One, it requires that you have to actually be involved in real estate. Just know you probably want to pair that with a serial type investment strategy. That way you're constantly recycling that pool of losses. All right, guys, I know we have questions coming in. I want to reserve those for the Ask Me Anything part of our show. But just to wrap up here, we talked about what depreciation recapture is. What are the different types? How is it, in broad strokes calculated? What are the different ways that we can do to partner with their CPA in order to get them the information they need to help you understand how it's going to impact your situation? And then, of course, several different ways that you can sidestep or possibly eliminate depreciation recapture altogether. But if you are wanting to get more information, or if you want to hang out with us and want us to help you understand your investing goals, you can go to passiveinvestingwithwhitney.com. Feel free to sign up there. All right, guys, I know we got questions coming in. I'm going to jump over to the Ask Me Anything part of our show. Oh, a question came in. How do you know the timing to sell an asset as an LP? Well, so you need to continue to read your deal updates. Okay. So one, when you invest, there's going to be, the business plan. What does the operator intend to do with that asset? Do they intend to, hold it for 5 years, 6 years, 7 years, 10 years? Okay, that'll give you kind of understanding so you can, in theory, time out some of your investments. But we've got some variables in there, the market, a very large variable. Okay, we as an operator, they're going to always try to sell at the height of the market if possible, but more importantly, protect investor capital. Okay, so the operator should be communicating early and often if they see the reason that they should need to sell an asset, either because they're going to be able to harvest a great gain, or if there's like something challenging happening in the market and they feel like, oh wow, this particular we've been invested in, say, like Atlanta, Georgia, and we feel like Atlanta, Georgia is now completely flooded and the supply demand metrics are out of whack. We need to get out now in order to preserve investor capital, right? That could be a reason. I'm just coming up with a hypothetical situation there. Okay, but the operator should be like, hey, we've listed the property for sale. We are engaging a broker to determine the value of the property because we plan to list it in 2025. Maybe the next update says, hey, we've secured a broker is now listed. We plan to exit in 2025, right? So they should be giving you just these quick, like little snippets for you to understand, oh, they're actually taking active steps to sell this property this year. All right. So again, that's all going to come through your investor updates. Having been on the investor relations side of things, working with an operating team, I know a lot of passive investors don't read those updates. I highly encourage you, come up with a system to do that. And one of the best ways that I've done it personally is I have created an email filter in my box where all my updates go into one file folder. And I sit down every Friday and I see what updates have come in from all my operators. And I'm staying current with all those updates. So come up with a system. Maybe it's bi-weekly for you or once a month, but at minimum once a month, be reading those updates. Oh, follow-up question was, does the sale happen when the sponsor plans to sell the property or other sponsors want to sell due to the same economic situation? It really all depends. There's a number of different reasons why an operator might want to sell a property, right? One, the best case is they've generated, they can hit it out of the park with investor returns and play a little bit of Monopoly and trade up. That would be amazing. We're in the growth part of the market cycle. Maybe they see a supply demand imbalance. Maybe there was a debt issue on their property. Maybe there's a physical obsolescence issue on the property and they need to sell. Just think about any reason why you would want to sell your own rental piece of property, and the operator might want to do that too. Now, the operator is going to think in terms of, what's best for investor capital at that particular time, and more importantly, how to protect it. Do most real estate syndications qualify for 1031 exchange? How do you know which do and which don't? It's not about qualifying for a 1031 exchange. A real estate syndication, pretty much just think about it. Like, let's just take a multifamily piece of real estate that's been syndicated. That operator could do a 1031 exchange. Just know they have to abide by all the same rules as a normal 1031 exchange. And sometimes they can be really tricky, right? So you, one, have to, survey all the investors that are in your deal. And according to whatever you've laid out in your operating agreement, say 65% of the investors need to vote, yep, we want to go forward with the 1031 exchange. So that's hurdle number one. Who wants to do it? Hurdle number two, can you actually find a property to exchange into? That's a great deal, okay? Because one of the best times to do a 1031 exchange is at the height of the market. And I see guys raising your hands. Please put your question in the Q&A box or the chat box. That's how we'll handle questions. I'm not able to open up mics for people. But anyway, so for the 1031 exchange, if the best time to do a 1031 exchange is at the height of the market, it's also kind of hard to get the best deal on a property because the property you would be trading into is also more than likely at the height of the market. So 1031 exchanges are amazing opportunity for investors. I will personally, this is personal opinion, nothing more. If I'm getting bonus depreciation, and especially if 100% bonus depreciation comes back, I might want to consider continuing to just pay my tax on the deal, get invested in another deal in the same year, and essentially I'm moving up my basis and I'm using my losses to continue to help me do that. So it's not 100% wash, but it can be, that can be another very powerful strategy, if you're not able to, and here's the thing, you're not able to choose what property you 1031 it into. You either stay with the entity that's selling and you go into the property that entity is going to buy, or you got to take your money out. Okay. You don't get to choose. You have to stay with the operator in that particular entity. Is depreciation recapture at your regular marginal rate? Oh, David, I'm not an accountant. This is where I kind of stripped out all of that wording there because those things, the tax rates change. And I wanted to have a piece of content out there that was a little bit more evergreen for people, especially since we haven't had the update from I shouldn't say update, just since we have all these tax laws that are getting pushed through Congress as we speak this week. I didn't want this to be obsolete by the next week. So how I can answer that question is talk to your CPA on how you'd be taxed at what rates and what rates would actually apply to you. But again, there's a lot of different ways that you can actually sidestep depreciation recapture and capital gains taxation without even having to get into calculating the tax rates. How is the suspended passive losses classified? Is it classified as capital loss and then be used to offset the capital gain at exit? That is a great, I'm not an accountant. So this is where you are going to partner with your accountant to understand where they are suspended on your tax form. But there is a form where all your suspended losses are, um, you know, are logged. Um, so that would be a great question for our CPA next time that we have them on here is you can get into all like the nutty detail. I just more importantly wanted a regular passive investor just to understand that you have more power to arrange your affairs as such to limit, if not significantly, not just limit, but reduce or eliminate your taxation that you pay if you partner with your CPA very early in the process. When the market presents the good opportunities, isn't it a lot of times the high sales price time? If we, yeah, so yeah, that's exactly what I was just describing. When you go to sell a property, either you personally or an operations team, if you are trying to capture the max upside, okay, you're probably at the high sales price. Um, especially if you're going to stay in the same market in the same asset class, you're probably going to pay the high sales price in order to get into the new asset. Now that may, if your hold is a long-term hold, like a 5, 7, 10-year hold, that's, we've got time for markets to cycle there. That might be a good strategy. It might be a good strategy even to pay a higher sales price on a particular property if it gets you into an asset to where you have more room to, um, push rents, do some sort of value add strategy, right? If you've got a huge asymmetric upside gain, that's still a really good time to trade. It can be a great time to move from like a high appreciative market to, because not all areas in the United States cycle at the same time. So real estate's very regional. So say like the Northeast has been super hot. You can lock in your high appreciated sales price, but maybe the Southeast is up and coming. Okay, then you can actually move your capital into a market where again you have more asymmetric upside. So it's not a blatant statement that we can say across the board. Okay, it's very much more nuanced. But I think the take home here is if you're investing, say, like in Austin, Texas, and you're selling at the top of the market, you're probably not going to reinvest in Austin, Texas, in an asset that's also at the top of the market unless there's a huge upside strategy for that. Okay. Our rental incomes reported in K1 box 2 net income loss, gross values or net values after depreciation losses. Guys, I am not a CPA. This is why I always kind of defer to like the experts. Okay, so what I wanted to again share with you is the overarching models. When we get into the actual tax part, we've got to partner with the experts. And I'm not even going to try to guess to demystify that for you because we'd need to bring on a CPA in order to help you specifically get through that. Can the proceeds received by an individual LP from the sale of a syndicated asset be put through a 1031 exchange? No. Why is that? Is because you are, so let me back it up. More than likely not. Doug, you would have to stay in the LLC. And, in most cases, most operators, I think that have set up their operating agreements that 60 to 65% of that LLC has to stay together to do the 1031 exchange. So you would stay in that LLC, go into the exchange into the asset that LLC, that the operators choose for that LLC. You cannot take say like you invested 100K, you can't take your own 100K out of that limited partnership and then 1031 into another. That's not how that works because you're actually investing in a business, not a hard piece of real estate. You're investing in shares in an LLC, and so it's a business. And so again, this gets into like some nuances here. Now, you do have opportunities. Remind you, you could, if you have a large gain, you could do like reinvest into other assets that kick off depreciation recapture. That's probably your best bet if you want to move out of that LLC. If you don't want to do the 1031 exchange for them, that's probably going to be your best way to offset that. Okay. Yeah. So here is one way that if you own your own single family building or your own multifamily building, whatever that piece of real estate is, and you sell and say like you have $1 million in a 1031 exchange, you at that time could potentially partner with an operator and go into what we call a tenant in common relationship with them in 1031 into a project if they are accepting 1031 money. Okay. But if you're investing as an LP, as a limited partner, you have to now stay with the tenant in common. Okay. You can't take your gain and create a tenant in common. Woo, okay. Somebody asked me, do you have a session on the sale of the property, the process, the pressure, the close, the celebration? Uh, no, but that is a great topic, for us to potentially cover. I think there's going to be a lot of celebrations here in the next like 12 to 24 months of as the operators are able to, start exiting deals again. So we'll make sure to put that on the list. How long does the multifamily sale usually last? I've seen sales go super fast and 45, 60 days, which for multifamily is really incredibly fast. If you follow my Multifamily Investor Nation channel, you'll see deals where it's taken a year and a half to 2 years to close the deal, just through all the back and forth. So I would say most deals, by the time they get under contract, are generally about 90 days close. So 30 days for the operator to perform their due diligence, 30 days to get the lending, and then maybe two 15-day extensions, which gets you to 90 days. Now, if the property that's being purchased is a loan assumption from Fannie Mae, Freddie Mac, that could be extend that timeline because Fannie Mae, Freddie Mac don't exactly move fast. So that could extend out timelines. And then sometimes you get retrades, things fall out of contract, so sometimes it can take a long time. I know I apologize, not we, but I'm in a deal that is in Florida area. I know that's a big state, but I'll just keep it pretty generic in Florida. And it was under contract to sale in early September, into August, early September. Well, guess what happened in September, October? Two hurricanes. And it fell out of contract. The buyer walked, and now the buyers come back to the table 6 months later because they wanted to understand, property repairs, insurance claims, what was going to happen to that particular area. But I mean that sale was probably almost closed at that particular time when so if let's say it sells by the end of July, that will have taken a year to close that property. So it really all depends. Real estate is a kind of a nutty game like that. What's motivating to say celebration in the next 12 to 24 months? Uh, the market's still struggling from all the talk. Yes, there are things that are continue to lead it to be a struggling market. For sure. And not all the headlines are doom and gloom in real estate. So there are a lot of positive things that are happening in real estate for sure. And so I think you're going to start seeing, remember this. We've talked about this quite often, and I know not everybody catches every episode. Multifamily has been in a recession for quite some time. Multifamily is starting to pull out of the recession. But now we have the general economy Self-storage coming right behind it, hotels, general economy, office, retail. There's a lot of things that are coming right behind it, but not every part of the business, multifamily, real estate, all that, it doesn't all cycle together. Okay, so yes, general economy, we've got a lot of uncertainty happening there. We have a lot of things that are happening between the administration and the Federal Reserve where they've got to thread the eye of the needle in order to give us a perfect quote unquote soft landing. Will that happen? I don't know. But that, there are some things that will impact certain parts of the real estate environment, but they don't necessarily cycle altogether. So I think we're going to see some positive things in the next, 12 to 24 months, really start happening, especially in the real estate side of things. All right. And if you guys have followed me for any amount of time, you know that I'm actually pretty conservative and pessimistic about stuff. So the fact that I'm saying there's some positive things on the horizon in the next 24 months, um, you know, uh, I'm feeling good about it for sure. All right. Let's see, we got time for like another one or two questions. Oh, thank you so much, Franklin. All right, guys. Well, thank you so much for spending your time, not only like again here with me, but also investing in yourself. Always, I love the questions that you guys have challenging me. It does make me feel like we need to bring another CPA on because some of you guys like really want to get in the nuts and bolts of taxes. But anyways, thank you again for being with us. And I hope you had a wonderful Memorial Day weekend, and we will see you. Rob Gallo will be stepping in for me next week. I will be at a conference, so I will see you in 2 weeks. All right, thanks, Doug. All right, guys, take care.